how much can I afford to borrow? What do I qualify for? Super common question. And the thing about this is it's a moving target because mortgage interest rates are changing. One thing I will say is if you truly are looking to buy something, even if it's a year out, I think it's highly encouraged by myself and others to go and get yourself pre-approved. It doesn't cost you anything. And by providing income documents, having even a soft credit pull done, having all your information looked at, reviewed by a great mortgage broker is going to be something that is super valuable to tell you exactly what you qualify for. Now, I know people are just like, you know what, Matt, I don't want to go through that. I just want to have a rough idea. And I'll give you that as well. If you don't want to go to greatmortgagebroker.com, talk to me and my team, get yourself pre-approved. You can know a rough estimate of what you qualify for if you go anywhere online and you just look at like, what's today's mortgage interest rate? You take that 7% and then you times that by, any amortization schedule out there is going to tell you if I borrow $400,000 at 7% over 30 years, what's that payment? Well, you've got to take that payment. You've got to add mortgage insurance. If that's applicable, you got to add homeowners insurance. You got to add property taxes. Now you've got a full mortgage payment. Let's say you did that math and you got yourself to $3,600. Well, when it comes to mortgage qualifying, your mortgage payment versus your income is probably going to have to land in the 35 to 40% range, depending on loan product, but that's a good, safe place to land. So if you make $10,000 a month, that mortgage payment by itself probably shouldn't exceed $4,000. One, for qualifying, and two, because you just don't want to put yourself in a mortgage payment that's not comfortable. Now, mortgage qualifying also takes into account all the other debts that you have. And so mortgage payment plus other existing debts that show up on your credit report is going to all factor into what's considered your back end ratio. The front end is just the mortgage payment. The back end ratio is mortgage payment plus all the debts, and that's versus your income. So in the example of $10,000 a month in income, you've got a $3,600 a month mortgage. You've got $900 more in car payments, student loans, credit card minimum payments, whatever that is that factors in there. And now you've got a 45% back end ratio because $4,500 a month between new mortgage you're applying for and your current debts versus the $10,000. So you could do some rough napkin math to figure out kind of what you qualify for. And I spoke to somebody recently. If you've got very little debt, maybe just take that mortgage payment that you've hand calculated and divide it by 38% to get what income you would need to qualify for it, or do it backwards. Take your income and multiply it by 38% and say, that's my target payment kind of max that I'm going to qualify for. That's rough. But to get a clearer number, again, you're going to have to go to greatmortgagebroker.com and fill out the form and connect with the team. All right. Fixed rate mortgages and adjustable rate mortgages. This is a super common question. I'm going to start off by saying, please don't believe the news that you're hearing that adjustable rate mortgages, somewhere to the tune of 1.7 million of them were written. Sorry, KCRA3, but I don't know where you get your data. It's just not very accurate or applicable. But current article talking about how the world's going to fall apart and real estate will crumble because of all these adjustable rate mortgages being written. Adjustable rate mortgages make up less than 2% of total mortgage originations. And so that's not happening. Now that we got that out of the way, let's talk about the difference between adjustable rate mortgages and a fixed rate mortgage. Fixed rate mortgage, your rate is fixed, which means your principal and interest payment is also fixed. You borrow $400,000 at 7% interest. You've got a principal and interest payment that stays the same month 1, 2, 3, all the way to month 360. The whole 30-year term, you've got the same payment and you've got the same interest rate. On an adjustable rate mortgage, you might have a fixed rate for a certain number of years, 3 years, 5 years, 7 years, 10 years. And then after that, it adjusts. You might see something that says 5-6 arm, 7-6 arm. What the 5 and the 6 represent in that 5-6 arm is it's fixed for 5 years, then every 6 months it'll adjust. So maybe for the first 5 years it's 6.5%. Then after 5 years, every 6 months, there's going to be an adjustment. They're based on different indexes. It might be LIBOR plus 2% or something of that nature. Just know that it's only going to be fixed for a certain amount of time. Then after that, it's going to adjust. When it adjusts, like that's something that, is risky for borrowers. So borrower beware. You don't want to necessarily jump into a adjustable rate mortgage if that causes you any sort of stress, and especially if the difference between an adjustable rate mortgage and a 30-year fixed is very minimal, like it is today. It's just not worth the extra risk to get yourself into an adjustable rate mortgage. How much of a down payment do I need? I need 20% down payment, right? That's the common myth out there on the interwebs. Good news, you don't need 20% down. Plenty of programs that exist and have existed that you can put 0% down on a home, whether that's down payment assistance program from a local county or state program. I've got access to wholesale lenders that provide 0% down across the country. Or maybe you're a veteran and you're eligible for a VA loan, and those require 0% down. There's 3% down conventional for first-time home buyers. There's 3.5% down FHA loans. So plenty of loans out there starting at 0%. To expand a little bit on the down payment question and why it's even needed, the more of a down payment you put, the less risk the lender has. And so as an example, on a $400,000 loan, you might be available to get a 3% down conventional loan where you're putting $12,000 down and you're borrowing $388,000. Well, while that's possible, you're going to have a mortgage insurance payment that's going to be relatively substantial for 3% because the lender has risk. Your interest rate might be a little bit higher as well. And if you think about it from the lender's perspective, that same $400,000 purchase, if you're putting $100,000 down, putting 25% down as a buyer and only borrowing $300,000 from the bank feels a lot more comfortable. They're at a lot less risk, so they can lend you that $300,000 at a lower interest rate without mortgage insurance, and will feel better about it. So while there are different down payment options available, the down payment is something that really the higher the down payment, the lower the risk for the lender, and the lower the risk for the lender, the better terms they're going to give you as a buyer. When it comes to credit score, that's really one of only two factors that lenders look at when they price a loan. You can have a lot of factors that go into whether or not you qualify, but after you know that you qualify, the only real things that affect your interest rate and your mortgage insurance, so the terms of your loan, are credit score and loan to value. And loan to value, again, is down payment. If you put 5% down, your loan to value is 95% because you're borrowing 95%. And so when you've got somebody with a 680 credit score and another borrower with a 760 credit score, you're going to get a lower interest rate with a higher credit score, and you're also going to pay less in mortgage insurance. And so the lender, it's all just a kind of risk model. This borrower who's got a 760 credit score and is proven to be really, really financially responsible, we can lend to them at a slightly lower interest rate. We only got to collect $68 a month in mortgage insurance. Maybe the 680 borrower, hey, you qualify. We're happy to lend to you. Your interest rate might be a quarter higher than the 760 credit score, and your mortgage insurance might be $95 a month instead of $68. And so that credit score is going to directly affect the pricing you get. For most people, there's going to be a threshold on minimum credit score for qualifying. That'll vary between VA loans and FHA loans, which are generally the most forgiving. And then most conventional lenders will need at least a 620 credit score to get a conventional loan. And so it factors in minimum credit score to qualify, but then after that, where your credit score lands and which bucket is going to determine the terms you get, mainly the rate.